Hello, everyone, and welcome back to the G360 podcast. Today, we are joined by a very special guest, Mr. David Wagner from Aptus Capital Advisors. David, how are you?
Rex, thanks for having me. I'm doing great.
It's going to be a very fun episode here, and I'm sure our listeners will enjoy it very much. For everyone out there that doesn't know David, David is the head of equities and a portfolio manager for Aptus Capital Advisors. And Aptus is our OCIO, so our outsourced chief investment officer, and really one of our partners that have helped guide us and structure us through building our portfolios. So Dave, I want to kick off the conversation by just telling us a little bit about who Aptus is, right? Aptus is not a big bank based out of New York City. Their structure and culture is very different from that. So tell us a little bit about Aptus and ultimately how you ended up joining up with Aptus.
Yeah, Rex, that's a great question. And when we're presenting around the country, we always say that Aptus Capital is based out of LA. They don't know that that stands for Bocephus's definition of LA, which is Lower Alabama and not Los Angeles. And if you're listening to this podcast and be like, wow, you guys are pretty crazy for launching an active ETF shop out of Alabama. Well, I would agree with you. You are correct. We were definitely crazy when we started the firm back in 2013 and really kind of went full throttle into the active ETF space in 2018. But one thing that actually, there's two things that probably very much differentiate ourselves versus a lot of our peers out there in the industry, where we have been able to get some type of competitive note from a firm based out of Alabama. But the first thing is going to be on our services side. We complement a lot of our active ETFs with a lot of ancillary services to help the end client and the advisor themselves kind of bring and, more importantly, democratize what a lot of people do on family offices and bring it to kind of the widespread. And the second thing that kind of gives us a competitive edge versus our peers is exactly what you touched base on there, Rex. It's that, we're not a big bank. We're not a big shop. We don't have a whole lot of red tape here at Aptus. And I think that's a benefit for us. Like when I'm at conferences or talking at panels, like you speak to any big bank or any big broker, like they have to state like house reviews. They have to stay within the bounds of what they're allowed to talk about. Dave Wagner, head of equities and portfolio manager, I can say whatever I want to say because I'm a big believer that you cannot teach conviction. And when you have conviction, you need to run with it. And when we have this conviction, it flows down from myself at head of equities, it flows down to a lot of the different partners that we work with around the country. And that allows those advisors and partners to be better financial translators to the end client, where we can show all the conviction that we have, from an investment perspective, from a market perspective, where they can feel very comfortable with what we're doing. So it's really fun, Rex, not having any red tape or hoops to jump through, that you can get the raw us. And I think we're definitely going to see that on today's call.
Yeah, I think that's why we enjoy partnering with you guys, right? You have a very strict framework and your conviction is so high. Your structure, one of your key motives that you have at the firm is you want to own more stocks, less bonds, while being risk neutral. So talk to us about why Aptus believes that. And ultimately, how did you come to that approach? And maybe talk about what happened in 2022 when the traditional ballast of portfolios having, a 60-40 approach where 40% is supposed to be in bonds for that balance and protection. What happened in 2022 that ultimately kept up with being bonds having a positive correlation to equities? So talk to me about that structure and the conviction that you have about owning more stocks and less bonds while remaining risk neutral.
That's great. I mean, two of our biggest convictions that we have here at Aptus is one, that bonds stink. We very much dislike bonds. I can't say hate because hate's a very terrible, tough word, but bonds stink. We very much dislike them. The second comment that we have, or second big belief that we have here, is that the hurdle rate for investors is actually much higher than what we've been used to over the past few years. And there's just such a necessity to unhitch your wagon to fixed income to be able to meet that higher hurdle rate that I don't think anyone's talking about right now. But when I'm talking to conferences, one, Aptus was built on the narrative that bonds stink, and we want to come to the market with a few different proprietary active ETFs and philosophies to directly combat our firm conviction that bonds stink. And when I talk at conferences now or on panels, I think everyone's really starting to come to that rationalization in 2024 and 2025. But the big problem that a lot of advisors and investment people have is that they don't know how to replace bonds in the asset allocation. I mean,
Right.
I have a big phrase here at Aptus is the hardest way to get new ideas into your head is to get the old ideas out. And the investment world, I'm going to rag on us for a second, but we're very antiquated in our thinking, and it's a very slow moving industry because
Mhm.
we know at the end of the day, money is very emotional, and a lot of advisors they want to grow their business and retain assets. And when you kind of throw the ropes and the wrench in the spokes of the tire of kind of changing up the dynamic of like you own cash, you own bonds, or you own equities. Like once you step outside those rounds, people become not very comfortable with investing, which makes them more emotional. And maybe the advisor doesn't retain those clients' assets. But I think we're really starting to reshape this entire investment overall environment for how we kind of attack the problem. Because like I told you, Aptus was built on the fact that we believe bonds stink, but we've come to the market with solutions that I think are the most efficient ways to continue to over-own equities, which we're a firm believer that risk assets are going to go up over longer periods of time, but putting guardrails in place to make sure that we protect on the downside. Because Rex, you said the best thing out there. Like, people have started to dislike bonds because they want to look to 2022 as kind of the North Star of what the new environment for fixed income is going to be. For reference, in 2022, the market had a pretty substantial pullback. In fact, the market closed the calendar year of 2022 down 18.33%. And our minds and what we're taught in school is that when the market pulls back to the high velocity, drawdown that we saw during the year, bonds should do very well. They should have this inverse correlation. When stocks go down, bonds should go up. Well, that wasn't the case in 2022. Fixed income, as measured by the Bloomberg Ag, kind of the North Star benchmark for fixed income, it was down 13%. So basically said another way, stocks and bonds were positively correlated to a point where we had the worst year for the 60-40 portfolio going back to 1937. And think about that. Like going back to 1937, that encompasses the COVID crisis, that encompasses the financial crisis, the dot-com bubble, the oil problems and the inflation problems of the 70s, World War II, like a lot of different things. So it's really started to restructure how people think about this market. And I'm just very excited for Aptus that we've been very pragmatic to try to come with solutions to combat this problem that really no one seems to have a solution for.
Right. And I think, what we learn as advisors is that, you need to continuously evolve with where the market's at, right? If you do not evolve, it's going to eat you up. And I think about when I was in school and I was being taught by the economic professors, right? They're consistently those professors that, I'd love to be an economist because you can be wrong 100% of the time and there's no repercussions, right? But in practicality, when you're talking about working with high net worth and ultra high net worth families, our job is to preserve and grow wealth over time. And so as the market evolves and changes, we need to evolve and change with it. And so I think it's something to think about where, you look on CNBC or you look on, the headline news, especially now, there's these doom and gloom and sort of fear mongering that comes into play where everyone is, looking at all this AI infrastructure right now, all the money that's flowing into the AI infrastructure, and everyone's calling it a bubble, calling the top. And it's just, you can't invest with such a short-sighted mind frame. And, at Generation Capital Advisors, we truly believe in U.S. exceptionalism, and we believe that the market will be and has been the greatest production of wealth out there. And I think that's something that Aptus and us share. But it's just a really interesting time to be in the market because there's so much fear mongering going on. And if you're not evolving, you'll get caught in those 2022 down draws when things change up and what's quote unquote supposed to be safe might actually not be in your best interest.
It's 100% correct. And I think that's why if you look at a Venn diagram between y'all's firm and our firm on our overlap of beliefs, I just don't think it's a Venn diagram. It's just kind of a circle. And I think that's why this partnership has evolved so well. But, Rex, you know me well. I have quotes for anything and everything. And one of the quotes I had on my board probably for like 10 years was, it was an ancient Chinese proverb by Lao Tzu. And it's like, resisting change is like holding your breath. The longer, you resist, the higher probability you have a chance of dying. And I think we have to be very pragmatic on how we think about this market. Like, Rex, think about this. Like every single data point that we look at in the investment world is hindsight bias. It's looking through the rear view mirror. Like, oh, hey, let's look at correlations. Well, correlations are based off of historical data. Or let's look, oh, we want to own this asset because it's outperformed over longer periods of time. So that just is why our whole industry is so antiquated as a whole, because we're utilizing past data to try to predetermine or presage what's going to happen in the future. And that doesn't always work because, to your point, Rex, the market evolves over time and we have to be pragmatic with our process. Let's look through the windshield, not the rear view mirror, to kind of skate to where the puck is going to. And I think that's something that, Generation Capital and Aptus is so great at doing it, is that we can be very adaptive and we can be very nimble and we can be very quick. And that all goes back to the point that, hey, we're not a bank. We're not a big brokerage. We can admit quickly when we're wrong, and when we're right, continue to let that mentality, outperform with convexity over longer periods of time. And I think that's a big thing on how you're going to win, because at the end of the day, Rex, you hit the nail ahead again. Like, we keep talking about what we're taught in college is wrong. Well, at Aptus, we want to focus on CAGRs, not college CAGRs like keg parties. We want to focus on CAGRs, CAGRS. That's compounded annual growth rate. And our ideal to make sure that every single client has their best, most efficient CAGR over longer periods of time. And I think that's by simply over owning assets, unhitching your wagon from fixed income. But let's put guardrails in place at the portfolio level in case the market does pull back.
Yeah, I love it. I want to take that time to sort of segue into how we built our portfolios and how we partner with you to structure and implement the portfolios that we built. We talk a lot about innovation and keeping up and making sure that you're adapting with the market. Our core belief, in our whole investment philosophy at Generation Capital Advisors is core and explore. And so the core foundations of our portfolios, we want them to be very simple, low cost, down the fairway investments. So we're going to be overweight S&P 500. We're likely going to be underweight international assets and small and mid cap over time. But really the goal is to be the market, not beat the market. And when we partnered with Aptus, right, there's two key risks of that we're trying to face or address in our clients' portfolios. And the first is longevity risk, and the second is drawdown risk. And so these are two risks that, we share the same beliefs on why they're so important and why they're pivotal to make sure that we're addressing for our clients. Longevity risk being how your money is affected in high inflation environments over longer periods of time, how purchasing power can diminish over time, and making sure that we own those equity assets so that we can outpace that. And then on the drawdown risk side, it's often overlooked of like what happens in left tails, right? What happens if your portfolio has a drawdown of 10%? You don't need 10% to get back to even. You need 11.1, right? And then it gets even more exacerbated if you go down even further. So talk to me about, we built these portfolios that are very simple. We added one of Aptus's active equity ETFs to help cultivate and attack those two risks. But talk to me about those two risks, drawdown risk and longevity risk. How does Aptus come into play, and how are you structuring your funds to help adapt and address those two risks?
Yeah, Rick. So at Aptus, as everyone has already heard on this phone call, we have a investment philosophy. It's more stocks, less bonds, while remaining risk neutral. But we also have kind of a marketing philosophy in its own, and it's what you hit on there: simple beats complex. And in our world of investing, Rex, you know this better than anyone. Everyone believes that complex problems require complex solutions. Like, that's just wrong, in my opinion. I think complex problems are best addressed with simple solutions. And that's what you're trying to do with your core plus explore approach. And you hit the two nails on the head that, the biggest problems I think facing advisors right now is drawdown risk and longevity risk. Like, I think every advisor focuses on drawdown risk because we all know, to your point, Rex, like the bad math of drawdowns. A 10% decline necessitates an 11.1% increase to get back to even. So there's a math component to drawdowns. There's also a, behavioral issue with drawdowns, that a 10% decrease in the market hurts 5 times more than a like-minded 10% increase in the market. And so all advisors, they've known that and they've preached that, and because it resonates with people, and they're willing to give some upside up to make sure that they protect on the downside. Well, I think that if you attack the asset allocation properly, you can still protect on the downside and participate better on the upside. said differently, and these are probably terrible words, like you can have your cake and eat it too if you think pragmatically, which we both do from a partnership standpoint, where you can own convexity or own volatility as an asset class to make sure you protect on the downside, but we're going to overweight stocks to make sure we participate on the upside. I mean, our industry, Rex, is ingrained with like trying to pick out like what's the next sexy stock, what's the next Amazon, what's the next Nvidia, what asset class do we love? Well, over longer periods of time, we've recognized that the security selection, because that's what's choosing stocks, choosing what asset class to invest in, that's called security selection. It doesn't drive long-term total returns. What actually does drive long-term total returns is having the right structure, right asset allocation in place. Yet everyone wants to focus on all their time on the sexier parts of, hey, I want to own Amazon, I want to own Nvidia, I don't want to own Apple, I don't want to own international. Yeah, those are great and fun to talk about, but they don't drive long-term total returns. And that's why our investment methodology and our marketing methodology of simple beats complex, like let's focus on what drives returns over longer periods of times, and let's try to exploit that. And how you perform in that left tail, which is the drawdown risk side, and even the right tail, and that's how you combat longevity risk, drives the majority of your returns over longer periods of time. We have another saying here, Aptus, is that the magnitude matters more than the frequency, meaning that the left tail and the right tail, from a frequency perspective, they don't happen that often, okay? But the magnitude of how you perform during the left tail and right tail drives your overall long-term performance. And I think if you focus on your left tail and focus on your right tail, your CAGR, your CAGR, your compounded annual growth rate will be better. Yet everyone just focuses on the drawdown, the left tail side. No one focuses on the right tail side. Like we know markets, Rex, tend to go up more often than not over longer periods of time. Like markets do really well, okay? And I think some of the wilder stats that I could tell you is that since 1924, so over the last 100 years, it's like 27% of the years since 1924 have seen a return of the S&P 500 be greater than 20%. It's like right tails happen in financial technical terms a crap ton, but yet we never focus on it. So we want to have a plan here at Generational Capital and at Aptus to make sure we protect on the downside, the left tail, but let's make sure we're not missing out on the upside, because that's how you directly combat, the higher hurdle rate that we always talk about, and it's directly how you combat longevity risk.
Yeah, I love it. And when you talk about structure, right, the structure is even more important in the one ETF that we use in ACIO. So, for our listeners out there that aren't familiar with our ticker ACIO, which is the third largest holding in our portfolio, it's the Aptus Collared Investment Opportunity Fund. And talk to us and educate the listeners about how it's structured, what differentiates you from other collared strategies, and ultimately, what can investors expect from owning an ACIO structure to, again, help own more stocks, less bonds, while keeping that risk neutral status.
The best way to explain ACIO, it is our largest fund here at Aptus. It gives you the ability to own insurance on your portfolio. If you think about your house, if you think about your car, everyone owns insurance on their house if they own one. And to legally be able to drive a car on the road, you need car insurance. Yet no one owns insurance on their larger nest egg, and that's their retirement accounts or their taxable accounts, which tend to be substantially greater in value than the aggregate value of someone's home and their car. So we own insurance on those parts, but no one has thought, pragmatically, like, how do I make sure that there's insurance on my portfolio? And that's what ACIO is trying to do. It tends to outperform when the markets go down, right? And it's going to slightly trail when the markets go up, but we have it in place at the portfolio level to kind of be the defensive nature to make sure we protect on the downside. And it's one of our magic elixirs and key ingredients, Rex, to combat that bond problem that we talked about earlier on this podcast. But when you create a fund, specifically out of LA, again, lower Alabama, you almost can't create funds that are very new to the market. We actually did that with one of our strategies, D-Risk, and it's done absolutely awesome. It's actually the number one performing bond fund in Morningstar. But when it came to ACIO, we're like, there's a lot of peers out there that we think are doing something inefficiently, okay? And we think we can create a better mousetrap relative to our peers, where you can still give exactly what our peers are doing, which is protection on the downside, but have better ability to capture more upside. And it goes back to the tails, right? The left tail and the right tail. Like a lot of these, in a nutshell, ACIO is a hedged equity strategy, okay? You're hedging your equities. And that's what we're doing by owning S&P 500 puts on the market itself. The exact thing that you're trying to protect against downgrades. But much like a lot of our peers, we think we have great downside protection. Honestly, every peer in the hedged equity space has great downside protection. I think we're right up with the best of them, right? But what a lot of our peers miss out on is that they're willing to give up a lot of upside to make sure that they have consistent protection on the downside. And a lot of our partners out there, they basically, whether it's buffered funds or other hedged equity funds, from a simplicity standpoint, they might have 1 to 4 trades per year that, where they're always going to protect on the downside. But when you only do 1 to 4 trades per year, you can't take advantage of the intra-quarter volatility. While ACL is an active strategy where we can go in and trade not 1 or 4 times a year, we can trade 250 times a year because there's only 250 trading days in a year. And we just saw the opportunity out there to make sure that we have a better fund where we're going to protect on the downside, but have a better mousetrap for upside participation. And we do that through kind of our structural advantage and our deployment advantage. Our structural advantage in ACIO is that, a lot of our peers that run collar strategies, and a collar is simply three aspects to a trade. All right, you're long an underlying, let's say the S&P 500, then you write calls on that underlying asset, the S&P 500, which brings in premium, okay? And you utilize that premium to help subsidize the cost of buying protection long puts on the S&P 500. So in a nutshell, you own an underlying, you cap it up with a ceiling by writing calls on it, and you use that premium collected to put a floor on the fund, all right, to make sure you protect capital on the downside. But when you do that at the index level, which a lot of our peers do, it is inherently a poor structure, in my opinion, because you have negative asymmetry. Insurance costs more than upside. So your upside, all right, could be like 5%, but your downside to be which is subsidized from that put at 5% higher, might be 5.5% lower. And that's negative asymmetry because your upside's 5%, your downside's 5.5%. Like in investing, you invest to have positive asymmetry over longer periods of time. So we think that's a ill-advised structure. So what we do differently is instead of owning the S&P 500, we own a basket of stocks that's highly correlated to the S&P 500 and write calls or have the opportunity to write calls on every one of those names to help subsidize the cost of the put. And what that gives us the ability to is to raise our ceiling up because there's more inherent implied volatility on each individual stock. And so you can have maybe a ceiling that's closer to 9-10% higher, but still keep your floor at 5 or 5.5% lower. That's positive asymmetry, right? We have the ability to have more upside, all right, than downside. So I think that's where we get a better mousetrap than a lot of our peers. But then also from a deployment side, instead of just doing 1 or 4 trades per year, we can trade 250 days a year. So no matter when you get into our allocation into ACIO, you're going to have the same risk reward over longer periods of time. In fact, every single day. And with a lot of our peers, let's just say that, if they do 4 trades per year at the end of every single quarter, well, what if you put money into this vehicle, all right, but the market's already run 5% during that calendar quarter? All right, well, that means that, all right, you're already above your ceiling from an S&P 500 perspective, that you're putting money into a vehicle that can only lose money until those sticks are reset at the end of the quarter, at the end of the year. So I think that's where we have a better mousetrap than a lot of our peers. And I love that you guys own it because I do think it is, and I'm obviously biased, but I think we have the numbers for one of the best hedged equity strategies out there in the marketplace.
Yeah, I think it just goes back to our conversation earlier about innovation and structure. It's like, you guys are being smart financial engineers to create a better mousetrap as opposed to, using this antiquated thinking. And so, we love it. We'll continue to love it. And it's going to be a really core part of our portfolio. We talk about core and explore, right? That makes up one of the explore sides. One of the other explore sides is around the compounder stock sleeve. And so that's another thing that you're heading up. Talk to our listeners and educate our listeners about what the compounder stock sleeve is, what kind of conviction you have in those names. And ultimately, it's a very hard burden to get into that portfolio. What are the drivers or what are the areas that you're looking for out of all the stocks? You're hand selecting a very few that get approved to fall into this model. So tell us about what the compounder stock sleeve is and ultimately how these stocks are actually getting into that portfolio.
Yeah, the compounders portfolio, we've been running it since about 2018, and we've been very fortunate that it's one of the top performing large cap strategies out there in the universe. It's something we're very prideful about, and I think it all goes into the diligence that myself and the rest of our team do. We roll up our sleeves, kind of get our hands dirty to go find out, our favorite stocks out there in the marketplace, the names that we have the highest conviction. But I would say with the compounders portfolio, it's a portfolio of 15 different stocks. It's our favorite ideas. I'd say there's not a whole lot of trading that goes into this compounders portfolio. There's only maybe a handful of trades per year. I would say that's a kickback of the strategy that we don't do a whole lot of trades in a given year. But I have a big belief that trading's like a pie crust. The more you mess with it, the worse off it is. Like, we do all the diligence on these names before we add them to the compounders. Let's talk with management teams, go through all the 10Ks, Qs, do all the work that we possibly can to a point where we can trust the business that it's a very high quality business. Two, it's a very profitable business. It has a long runway for growth, has a lot of pricing inelasticity, which simply means that when prices go higher of what you're selling, it doesn't decrease demand, that they have that gives them the opportunity for operating leverage and margin expansion. But more importantly, that you trust the management team. Because once we add this name into the portfolio, I don't want to have to do all the heavy lifting to make sure that it performs over longer periods of time by trying to trade in and out of names. We trust the management team to execute their strategy over longer periods of time, and that will dictate, the ownership in the compounders portfolio. And, we take a long-term mindset when owning these names, not a short-term mindset, because like the epitome on how to compound capital is to find great companies with business moats and competitive edges that can outperform over longer periods of time. And that's what we try to do with this strategy. So there's not a whole lot of trading that goes on, because I want the management teams to do the heavy lifting once, we've gone through the burden of finding them and purchasing them. Because the best way to compound capital over longer periods of time is to expand your time horizon and to trade less. And that's why, we might see periods of underperformance with compounders. We've been very fortunate with performance over longer periods of time. But, I think we own some of the highest quality, highest caliber stocks out there relative to our peers. But the best thing about that too, Rex, as you know, is that, we're very transparent with this portfolio from a performance standpoint versus the S&P 500. But we also give you a tons of different arrows for your quiver, to give you that conviction that we have that these names are going to compound over longer periods of time. So you can look at our long internal research reports, some bull bear cases that are 1 page long, our quarterly notes, trade rationales, just to make sure that our conviction that I talked about before, flows downhill to our partners, our advisors, and obviously the end client, that what we're trying to do is the right thing over longer periods of time.
Yeah, we love it. And the material and the trade rationale has been a game changer for us and just our partnership, and ultimately just educating our clients and being transparent about what we own and why we own it. And when we're making changes, like, what's the culprit or what's driving that? So, we now have an understanding of how we partner with Aptus. We've used a lot of your resources, your expertise, and human capital in helping us cultivate and create a portfolio that we have super high conviction in, a low-cost indexing portfolio with a little bit of explore that we can sprinkle in depending upon the client's risk tolerance to either protect on the downside or protect in those left tails, but ultimately to have higher upside capture and own more bonds and less stocks. More stocks and less bonds. So, with that being said, the market right now is ever evolving, and there's so much headline risk right now, right? There's some different things that market's evolving. What are you seeing right now in the market in terms of where we're at, and how should investors think about investing? We talk all the time about how we're long-term investors, but it can be hard at times, especially with all these headline risks. Like, what are you seeing right now in the markets, and what do you think for investors? Should they sit put? Should they just continue with their current strategy? Should they think about some downside protection? Where do you think we're at right now, and what's your overall health check on the market right now?
Yeah, Rex, I'll answer that in 3 parts. Just kind of a quick synopsis of what's going on now. The second part, well, let's talk about the AI centric names and the headline risk of bubbles, and then let's cap that with talking about the hurdle rate. But when it comes to kind of a quick market synopsis on where I think we are right now, I think one, you have to own risk assets right now, and I'll get into that more on the hurdle rate side. But it does feel like each week, each month, each quarter is its own ecosystem right now. And given how high the stakes are right now, where valuations are, as we head through the rest of earnings season, it feels like we're kind of going to be a prisoner of market context. Now, I don't want to sound like an uber bullish person. I like to think I'm a rational optimist, but because there are, plenty of things out there to worry about. But I think everyone needs to hear the core tenets of this market. And it's that the Fed is easing financial conditions into a cyclical acceleration as the CapEx train continues to roll down the tracks. I think if you want to be a serious bear right now, I think I suspect that your timing, it has to be absolutely impeccable, or the fundamental setup, it just needs to change. Otherwise, you're fighting the Fed, you're fighting fiscal stimulus, and you're fighting, U.S. mega cap tech stocks. So I think I'm sticking with the reasonably bullish approach right now, heading over the next few months and in even longer periods of time. I know there's probably some more seasonal confidence in November and December of the years, but I think even past that, I think the path of least resistance continues to be up. While pullbacks are healthy, they're normal, they're going to happen. I think the long-term trend really remains intact.
Right.
Now, to talk about the second thing, like the AI area, the only bubble out there, I think, right now is there's a bubble of people calling for bubbles. Everyone wants to be the next Michael Burry, right? I think everyone's been trying to fade this AI-centric rally for quite some time. And what has that gotten you? Underperformance. Okay, I think that's why we want to own beta in our allocations, but with guardrails.
Mm-hmm.
Think about bubbles, though. Like, we're taught, I went to the University of Kentucky, and you're taught, that all booms lead to busts. And that, let's always go back 400 years ago, talk about the tulip bulb crisis. I think it was like in Denmark. Like, we're talking about a bubble that was 400 years ago. Like, bubbles simply don't happen as often as we want them to. We want more bubbles than anything, which is just beyond my imaginary, thought. Like, let's bet against this market because that sounds cool. Rex, you've heard me say numerous times that bears sound smart, bulls make money. And I'm a firm believer in that because at the end of the day, bubbles, they're going to happen. You just have to bifurcate it between good bubbles and bad bubbles. And I get that might sound like an oxymoron, no doubt about it. But I think bad bubbles are the bubbles that don't add to productivity gains. They tend to be bubbles around commodities. And that's the tulip bulb crisis of the 1630s. That's the housing crisis of 2006, 7, and 8. Or they could be around gold or any type of commodity itself. Like, those aren't productive bubbles. But there's one bubble that I didn't talk about. Now, that's a productive bubble. And I think there's no better North Star to look towards than the dot-com bubble. I mean, a lot of people made a lot of money during the dot-com bubble, and a lot of people lost a lot of money during the dot-com bubble. But I'm glad we had that bubble because all the ramifications and the benefits that we got from this evolutionary technology called the internet. Think of where we would be today without the internet. And you had a bubble back in 99, 2000, and early parts of 2001. All right. It stunk. It was tough. It was hard. But you had to look through the windshield to see some of the productive benefits that we got from the internet further into the future. Like, Facebook wasn't invented until 2004. The iPhone wasn't brought around probably until like 2006. Uber wasn't created until like 2012. And that's 12 years after the dot-com bubble. Like, yes, the dot-com bubble stunk. It hurt. We lost money. But if you were able to stay invested over longer periods of time, you were a direct beneficiary of what that revolutionary technology called the internet brought to the market. And I think that's what we could maybe see with AI, because if we do go into a bubble, I personally think we'll have an air pocket, which is very different than a bubble. It's at least a productive bubble, and there'll be long-term benefits to that. The last thing I would say here is the hurdle rate. I think the worst thing someone can do right now is become more conservative, own fixed income. Because if, let's say that, your dollar is losing its value of about 4 to 5% per year, which I'm a firm believer that's the case. In fact, if you go back to 1972, your dollar now, if you had $1 back in 1972, your dollar is now worth like 11 or 12 cents. Like, no one understands that, the Fed targets an inflation target of 2% per year. Inflation right now, the government reading is 2.5%. I think that woefully understates what the inflation rate is, or the value of what your purchasing power is losing per year. Mm-hmm. I think it's closer to 5%. I mean, Scott Bessent, our U.S. Treasury Secretary, said it best back in November. I'm not worried about our debt problem as long as we can grow our economy, grow the market faster than our deficit. All right. And if we do that, we bring down the overall ratio of debt to GDP, which is healthy, which is good. And we're running a deficit closer to 5.5%. All right. Not only that, we're growing our money supply, the M2 money supply, by about 5% per year. I think if you do the right adjustments to the government CPI rating, like the inflation number is closer to 5%. All right, so let's think our hurdle rate is 5% right now. And I can give you all the statistics in the world until I'm blue in the face to show and prove that. If bonds are trading at 4% rate right now, like, all right, I think you're just losing money safely, because after inflation, okay, you're almost losing 1%. Because if your dollar is losing its value by 5% per year and you're only getting 4% return on fixed income, there's a 1% mismatch right there. While you might feel all warm, safe, and cuddly and cozy inside, you're still losing money. Like when I went to my first class, Finance 101 at University of Kentucky, you're taught you invest today for a better future. And if you invest too much in conservative assets, well, you're not investing for a better future. You're investing for the same future. And that's not what I'm here to invest. That's why we want to own more stocks, less bonds, because we believe stocks have a better ability to compound capital over longer periods of time because they have more leverage to pull from a growth perspective than bonds. And so it's overweight the asset class that can get us above that hurdle rate, have a better CAGR than bonds, but keep guardrails on the side by owning volatility as an asset class through strategies like ACIO.
Yeah, I love it. And I think, to our listeners out there, it's just important. It's very easy to sit on a lot of cash right now. You're looking at and especially over the last, I'd say 12 to 24 months with the high risk-free rate of what you're earning, but you need to be intellectually honest about what's happening to that dollar and what's happening to your purchasing power. And ultimately, that's why we have partnered with you in helping to address that with building portfolios that are set to attack face on that longevity risk. So we have an understanding of who Aptus is, who Wagner is, what sort of structures that you've built, and the financial engineers that you guys are in building really strong structures to help with those high convictions that you guys have. For listeners out there that want to gain access to these structures and to these strategies, it's very simple. Through the ETFs, you can purchase those ETFs through any of your major custodians. If you want to learn more, you can talk to us, or we can set up a call with some of our Aptus partners here. But ultimately, Aptus has been an exceptional partner to us in helping us build a really strong foundation to face head on the risks that we believe are the biggest risk for our clients and for our investors. So, Dave, I really appreciate you spending some time with us today to help educate our listeners and clients out there. And if you want to learn more, you can go to aptuscapitaladvisors.com. If you want to learn more about us, go to generationcapitaladvisors.com. Feel free to schedule an introductory call with myself or Sam, and we'll be happy to continue educating you on our structure, on Core and Explore, on owning more stocks, less bonds, and remaining risk neutral. Dave, it was a pleasure. Hope everyone has a great rest of your day.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.